Hi, everyone. It is Thursday, April 6th, 2023. Welcome to TechTO Quick Takes. I'm your host, Alex Reilly, and here are today's headlines. The funding market is beginning to thaw. Late stage tourists are leaving, but not quietly. We'll discuss more on what that means. And in our lightning round, we review more raises and announcements making news over the last few weeks in tech. And to help me break it down, Alex Norman joins me. Hi, Alex.
Hey, how you doing?
I'm doing great. It looks like you're probably doing a lot better than I am, just
Well,
given your background.
we're talking about thawing, so I thought I'd go someplace that would help get rid of the snow. It's a bit warmer.
Absolutely. Absolutely. At least the weather in Ontario is starting to get a little bit nicer and coming back to life here, which reflecting what we want to talk about in our first headline, just how the funding market is really starting to come back to life. Obviously, this is really good news, but I want to get more into the specifics of what this means for everyone. So why don't we start with just what the news is around all of this?
Well, the news is that there is funding news.
Mhm.
Starting in late Q3 of last year, when we started preparing for the quick takes, it was getting more and more difficult just to find any funding news.
Yeah.
Um, while I was preparing for this one, I saw at least 15 plus announcements in the last couple of weeks, which means that funding rate, or at least rounds are being announced again.
What else does this mean?
Well, the first thing to remember is that companies don't actually have to announce funding rounds. And when they announce them, they don't have to be at the same time they raise it. So you could raise a round, be quiet, and 6 months later announce it. So trying to analyze the actual funding market by the rounds announced is difficult, but I think it's directionally right. Given that we're seeing consistent flow of new rounds being announced, I think it's comfortable to say that we're off the freeze of Q3 and Q4, and that rounds are starting to happen.
And so you say like not all companies have to be announcing rounds. So like why are they announcing rounds again? I know they're not obligated to, but just maybe go further into that.
So there's a few reasons companies do announce rounds,
Hmm.
and in the early 2020s, everyone started announcing them because of the following reasons. When you announce that you have money, it's a great way to advertise to potential employees that
Yeah.
you exist, that you're backed by credible people, and it's an employer branding, employer recruitment exercise. Second thing is when you announce a round, VCs who missed on your round maybe didn't know you're rounding, didn't know you existed, may get excited and come quickly with a follow-up round. And we saw a lot of that. Like, hey, usually it's 18 to 24 months between rounds, and then in the last few years, it got to like 3 months in some cases.
Hmm.
And then finally, it's a signal to customers you are the leading company in the area, that you're well financed, and that that you're de-risked and it's okay to partner with you. As the market's cooled, it became easier to hire and harder to do a quick up round. And so startups have had less reason to announce than they have before. So it's returning to like the early 2010s where not
Right.
every round was announced. And in the States in particular, lots of people are reviewing government filings to see who's done rounds and figure it out.
Right. I mean, those all sound like really logical and positive reasons why someone would want to make that public. But on the flip side, so why might they not want to? And what's the upside for keeping information like that private?
So I think there's two reasons not to announce a round. First is success encourages competition. So when you've announced you raise a round and if you don't have like a strong moat or it's still early days, some ambitious team might say, "Hey, we're struggling. Let's go do it with that." Or someone just may enter the market. So it's better to succeed in stealth and be forced to tip your hand. And I think
Okay.
second thing is um, a funding announcement can be looked as a way of getting free marketing and PR. And it was much easier to get that outside the tech community when things were good. And now it's less and less tech rounds are being covered by general media. So you might be better waiting off to pair the timing with some other big announcement. Hey, we just partnered with, I don't know, RBC and we raised a $6 million round. Is much more likely to get you in the Global Mail than just say, hey, we raised 6 million.
Just to go in a little deeper on just the market in general. So what are we not seeing around this?
So let's break this down by stage. I think the market is it's we there's different things happening at different stages. There always is. In the
Hmm.
early stage, so let's call these the smaller checks.
Yep.
Not seeing funding of companies where there's three plus competitors in space that are viewed as competitive. So VCs are saying, hey, you know what? This looks like what they call a red ocean. Lots of sharks going after the blood. we don't want to compete in stuff where it's not clear that you can easily emerge a winner with big margins.
Okay.
Also, likewise, we're not seeing tech-enabled businesses like direct-to-consumer e-commerce companies. Again, it's a margin thing. And enterprise SaaS actually seems to be a bit slow, which surprises me when I look at it, because that, the traditional software company um, doesn't seem to pick up like the other ones. The mid-market, these are like the 15 to $30 million rounds. I think they're starting to happen again, but they're just not being announced. I actually know a few that have not been announced. And then late stage, like
Right.
these are, 50 to $100 million rounds. I don't know if those are happening, and if they are, they're not being done by tourists or at nosebleed valuations.
Okay. And another point that we usually, or theme we talk about a lot, is trends that we're seeing. So is there any other trends that you're seeing within the market you want to
So,
highlight?
the obvious one's generative AI, but there doesn't
Yep.
seem to be much of that going in Canada. Are you talking about any other trends?
Yeah. So if there's like anything around maybe like health tech, climate, anything
Oh,
like that, like,
yeah. So I think you're right. I think too, you mentioned, I think health tech seems
mhm.
to be very popular now for a few
Yeah.
reasons. I think one is I this is a post-COVID trend that's impacted the healthcare system around the world. Got challenged and feels broken. So there's a lot of people. There's a lot more desire to change healthcare by
Yeah.
incumbents. There's a lot of technology breakthrough. So there's a lot of just investment in the health tech stack up and down. I
Right.
think you're seeing climate continue to get funding and be
Mhm.
hot for a while now. And I think you're seeing more going to deep tech, because the idea is going back to what do investors want? They want something that gets a lot of revenues and has a lot of cash flow. And the feeling is if deep tech is risky, but it
Yeah.
isn't under the technological mode that's hard to replicate. If it works, there's a huge return. So we're seeing a lot more money be put back into deep tech.
Right. Especially since COVID, just around the health tech sector in general, we've seen a lot emerge, obviously, and a lot of changes being made within healthcare in general and how we access care. So why now? I mean, we know companies don't have to make announcements, but why is there so much funding news happening, especially right now?
Well, so again, I'm not going to focus much on news, but more on the wise funding happening again.
Sure.
But the public markets have rebounded. And actually, AngelList had an interesting piece they released. They studied and saw that valuations and funding for private markets, so venture, trail the public markets by about three quarters, if I remember the data correctly. So you've seen the public markets have started rebounding a bit. So I think we still probably see downward pressure on the private market valuations. So I think what's happening is founders realize they have to, they're not going to raise at the 2020 or 2021 valuations. VCs have money to deploy. The public market's looking a bit better. So all these things feel like the market's starting to come to market clearing prices, a bit of stabilization, and money's on the sidelines that has to get put to work.
And lastly, just to wrap it up, additional takeaways for our community.
So investors are always out there.
Yep.
And what they're historically looking for hasn't changed. The valuations may go up and down, but they want someone to build a company that can grow quickly, can grow to big revenue, and produce cash flow. So there's money out there to be raised no matter when you start a company. So the best time to start a company was yesterday, but the next best is today. So I always encourage founders, if you know there's a problem you want to solve and you think you have the solution, don't try to time the markets. As I said in the previous thing, valuations feel like they're getting back to more of a long-term norm. So like what we saw in 2020, 2021, you've heard many times, was not the normal multiples, was not the normal valuations. I think what you're seeing is people realize that, hey, what was normal was like 2015, and we're returning to that. Um, Please don't start a company, because I just said it was in a hot area. Hot
Mhm.
areas come and go. And finally, with less announcements and less clarity in how much capital any company has, if you're looking to join a startup, do your due diligence. Understand what the cash flow is. Understand how much runway is. Understand how they're doing, and think of it like an investor.
Right. I like that you touched on just timing, because I know that's a frequently asked question we get a lot. It's just, when is the right time if I have an idea to start a company? So you kind of hit on a bunch of points related to that. Before we get to the next headline, I just want to reiterate that news and stories like this, if you can't catch Quick Takes Live and you want sort of a wrap up of everything, or a wrap up of our events, right to your inbox. You can subscribe and get all of those updates in our newsletter, which you can subscribe at techto.org/newsletter. We've been working to do a lot more in-depth company highlights and also event recaps as well, because we have a lot of folks that are all across Canada that might not be able to attend our events in Toronto. Alex, is there anything you want to highlight about what we've been working on?
Well, we're starting a new series that look at the alumni networks of Canadian startups. You may have not known had alumni networks. So, got the first one either being released or released on Top Hat, and we have many more planned. And I think it's an interesting way to look at the impact one startup can have on the ecosystem over time.
For our next headline, late stage tourists are leaving, but not quietly. I want to go into detail about just what all of that means. So let's just start with there's a couple stories that we're combining into this headline. So what's the news there? And just start by breaking.
Well, you know, I love combining articles into headlines because I think it's easy to analyze one piece of news. More
when it works for a segment, let's do it. So
you know, what's really driving news. So there's two stories going around right now about companies that are, you know, struggling from a valuation perspective or ongoing concern. So, you know, there was Renault Run filing for creditor protection. We talked about creditor protection last time we did quick takes and why it's good and why it exists.
Yep.
But the article's going to what was going on there. And then ClearCo new round is, you know, is rumored to be at a significantly lower valuation than their unicorn round. And
so just more detail on just what that means, especially the creditor protection portion of that for Renault Run.
Well, Renault Run, from what the stories I read, seemed to have investors come together multiple times, try to get around together to continue financing the company. They couldn't, so they went to creditor protection, which basically allows you to rearrange your strategy, get rid of debts, and come out stronger at the end. ClearCo, you know, is rumored to be doing a new round at a significantly lower valuation. Like, don't want to get into the who, what, or where. But basically, this both means that they need more cash and they couldn't get cash at the last round valuation.
Right. And I think you probably don't want to discuss what went wrong, because obviously there's a lot of things that can transpire and happen going forward from this. So why don't we look at what they have in common, especially around the tourist investors? Yeah. I just don't know what that means.
So tourist investors is a term given by VCs to funds that come into the ecosystem when valuations are going up to the right, the market's hot. They come in with large amount of capital. They seem to be valuation insensitive, invest a lot, and then when the times get tough, they seem to disappear. What's common about both these stories is they both raise from companies I wouldn't say are not, you know, normally considered tourists, but act like tourists. Okay. So Renault Run's last round was led by Tiger, and ClearCo's last one was led by SoftBank. Tiger's been investing in tech, public markets, and private market for 20 years, and SoftBank for longer. But both seem to act like tourists. When the times get really hot and heavy, they're deploying capital quickly, and they're valuation insensitive. And now that stuff are getting a bit tougher, they're acting differently.
So, in addition to that, what might be the downside of having a tourist investor?
So as tourist investors leave, they're like drunken English soccer fans leaving a party. It's a mess in their wake.
Okay.
So most of the companies got money, have real businesses. What happened was they had unrealistic valuations. Now that these investors don't see the likelihood of strong returns, right, by putting more money in, they're saying, yeah, go raise money from other people. And it causes problems for these companies because when your lead investor from the last round walks away from the company, it just makes it harder to raise.
And how do we see this related to these two stories? How are we seeing this in the news?
Like first of all, let me be clear. No investor is obligated to continue investing in a company, and they should do what's right for them. What you see with the case of Renault Run, if the rumors are out there that Tiger tried to sort of do an arranged marriage with another Canadian investor, there's Dooley. So great, common investor, maybe the biggest investor by dollar amount in both companies, but they have very little in common that I can see. So at best, this was a distraction for both companies that were trying to continue to grow their business profit and grow the profitability. So that's not what you want to see. you know, and Clearco, from what I've seen is they're not supporting the new SoftBank round, which doesn't help either.
Right. And I'm sure a lot of this is also the information we'll find out is a lot of hearsay and rumors, but is there anything else that we know that we should be talking about?
Again, I haven't seen anything definite, but you hear chatter in the ecosystem that funds like these tourist funds are now again not only not investing, but they're asking for funds to be returned at the expense of other investors. They're threatening to finance. They're threatening to sue founders of these companies. They're saying, hey, we're going to go finance leaner companies. So not only you have an investor that's not supporting your funding needs, you have an investor that's becoming a distraction either by asking you to return money. They're threatening to sue you. They're threatening to go fund competitors. So it's just not the behavior you want in someone that you partner with.
Right. And I'd be interested to get your take on this question because I just want to know, obviously information around this exists, but why are more people not talking about this?
There's limited upside. If I'm a VC or I'm a founder, this is a long-term game. And the idea is that if I besmirch someone's reputation or say something bad about them, they might not be a partner in my future deal. Like, let's say the market gets hot again in 3 years, 4 years, you start a company today, maybe you want one of these tourist investors to come in at a high valuation and let you take money off the table. So it doesn't help to have said stuff that they don't perceive to be well. So there's not much upside in talking about this.
Right. And just lastly, as an investor personally, like what takeaways would you want to give to founders? What lessons would you want them to take from this?
It's very simple. Always diligence your investor. Talk to the founders of not only the companies that have done well, but the companies that have done poorly. Because when you take money from someone, it's hopefully a long-term partnership. And if things go sideways, you don't want it to be a headline bitter divorce, that would
right.
Be, so make sure you know who you're getting to business with. For the community, I'd also ask, don't rip apart the teams that are having down rounds. Their life is already tough. It's difficult. No one wants to they know that they're not as valuable as before. They know that something is not working like they planned. They don't need people beating them up and questioning them. We should actually respect these teams because to get to these big valuations rounds, they did something right. They built something, and maybe they'll turn a ship around. Maybe they won't be worth $2 billion, but they'll be worth $1 billion. It's still impressive. And you know what? If they don't work out, lots of learnings on what to do next in the right company. So I just ask, it's fun to shit on companies that are having a hard time, but still look at what they've accomplished. And let's focus on that because I think in the long run, not every company succeeds, and what we all learn and what they've accomplished is pretty impressive.
Right. I think it's really important what you said about the diligence around your investors. And maybe that's something that we do a deeper dive into for a founder FAQ, like how a founder should maybe like the process and the diligence involved in that, because it's one thing to have someone willing to go, hey, I'll help you. But I'm sure there is a lot more that needs to go into, that the process and the diligence around that. So that's very interesting, a takeaway. And I think a lot of people will resonate with that.
Add it to the list. We'll do the research and get that out.
Absolutely. And we'll post on social if anyone has advice or the process they went through. We'd love to hear it. So I'll definitely share something as well. So lastly, just to wrap things up, our lightning round announcements, raises, a lot has happened in the last couple of weeks that we want to touch on. So just what's the Montreal-based news we want to get into first? What's the news there?
So LE Health announced a $3.6 million round for its women's health hormone monitoring technology.
Mm-hmm. And why is this interesting?
So you mentioned health tech's hot. Mm-hmm. I think women health tech will continue to be even hotter as it historically has been underinvested in. Interesting, the round represents the largest amount ever raised by a women's health tech company led by a female CEO in Canada, and is the second largest overall in women's health category in the country. And finally, we had the co-founder Marina on a panel in Tech Montreal.
We did.
And it was actually her and another female health tech CEO, Lisa, from Assist IQ. And this panel is a must listen to. So I would include in the show notes and make sure everyone, because these women know what's going on in health, what's going about building a company.
Yeah.
One of the more interesting panels from the last year.
Absolutely. I'll make sure that's included and also do a bit of a touch on it in our newsletter as well. So the Skip the Dishes news, what's the news there and why is this interesting?
So Skip Skip the Dish's new CEO announced that the company is expanding beyond food delivery. So they start doing groceries. They're going to do stuff, many other deliveries. So I
Yep.
think there's a few things happening here. First of all, um, this is an example of how a company that's scaled up and has lots of fixed costs can enter new markets and immediately see margins. Look, they have the drivers, they have the logistics, they're putting some money into micro fulfillment, but they have the customers and know-how. So entering and delivering more is pretty cost effective. Second thing that shows is this market is going to continue to be very competitive. You have DoorDash, you have
Yep.
Uber Eats, which has a few impacts. First of all, small businesses now are going to feel more obliged to deliver, just like the restaurants. And if you talk to restaurants, these deliveries hurt your bottom line because it's an additional delivery margin coming out. So either they have to increase prices or they have to have lower margins, which, maybe they have more volume, but it's something that's interesting to think about from an economy perspective. And I think there's also an example going back to where say, hey, this is a super competitive market, which means the margins for any of these delivery companies aren't 80% software gross margins. And this is why you're seeing like VCs be a bit more careful about where they think it can be a competitive market, because even if you win the market, there's always someone else that can attack it. So DoorDash, they want a market, but there's continuously people attacking it, which keeps their margins in check, which, it tends to keep your returns in check.
Right. And yes, definitely a competitive market. As someone who also does grocery delivery and uses Uber Eats, I'm anxious to try another platform all the time. So that's great that they compete.
Another one we didn't even mention.
Pardon?
You can try Instacart. There's another one we didn't mention.
Instacart,
right?
Yes, exactly. There's also an app called Runner, which is delivery. It's more for like small grocery goods and alcohol, which is another one that exists. Again, all kind of competing for the same thing in that market. So very interesting. WonderFi, CoinSquare, and CoinSmart. What's the news there, and why is this interesting?
I think this is the least expected news of the year. We started talking about the consolidation of the Canadian crypto exchanges sometime last year, and
Yep.
Our opinion, we did a deep dive into it at our bigger quick takes, and we said, look, the market's highly fragmented. It's a local market. Yes, there's regulations around it, but it's a pure commodity subscale market globally anyways, and we had like 20 competitors, and now you're seeing the leaders consolidate. I still think there's going to be more consolidation. I still wonder with the markets, not necessarily the valuations being down, but the volume being down, these companies are still going to have a hard time proving to be strong businesses, and we're going to see more consolidation here.
Vancouver-based news, just Web3 specific news, actually. So what's the news there, and why is it interesting?
This is the flip side. Layer Zero Labs raised 120 million, I think, at a $3 billion valuation from A16Z's crypto fund, Bond, which is Mary Meeker, Christie's, Circle Venture, OpenSea Venture, Samsung, and the list keeps on going on. Sequoia Capital, I think, just like another 25 investors. Look, while I'm not happy about don't not pause about crypto exchanges and their potential returns, blockchain's not going away. And and the investment's less in the app layer right now. This is more the infrastructure. So what Layer 3 offers, Layer 0 offers is something very interesting. They enable a developer to build on one blockchain and then automatically make it interoperable with another 29. So from a developer's perspective, instead of building 30 versions of the same app or same tool, whatever they're building, they can build one, and they get distribution and through all 30. So future proofs them, because we may not know which blockchains exist in 5 years, 10 years, but odds are if they're doing the 30 most important, biggest blockchains, making it interoperable, your tools are safe. So it's an infrastructure play. It's highly valued, and you still see that Web3 is getting invested in.
Yeah, Web3 is not dead, as you said, and as we've talked about on a previous episode too. It's not going away. So this just solidifies that too. And last headline, I know why this is interesting, but it's related to Janet Bannister announcing a new round. So just get into the details about what it is and also why it is interesting.
Well, Janet used to be the GP at Real Ventures, left. She just announced a new independent a fund where she's a solo GP, 22 million raised. It's named Staircase Ventures. I guess it's a play on Bannister, her last name.
Yep.
She's going to be invest in post-product market fit companies, $500,000 to $2 million check. So why is it interesting? Always good to have more funds deploying capital in Canada, and we'll probably talk with her about why it's good on May 1st, which are our next in-person TechTO event in Toronto.
Yeah, definitely interesting, and it'll be great to hear from her in real life. And perfect segue. I want to wrap things up with just showcasing what we have coming up. So we have an exclusive event for our insiders. We have a social coming up on April 13th. If you are not an insider and you would like to become one, you will get free access to this event. I will post how you can learn more and also what our insider program would offer to you. If that's of interest, any insiders listening, we hope to see you there. Good turnout already. We'll be in Montreal on April 25th. Really looking forward to, getting back out there and talking with a lot of founders and innovators from the ecosystem in Montreal. As you mentioned, May 1st, we have a Tech Together. Janet will be there amongst other amazing founders sharing their journeys and what they're working on. And lastly, Retail TO on May 24th. And I will link all of the information on how to get tickets and all of that in our show notes. And also you can find it on our website, techto.org. Anything you just want to highlight before we go, Alex, about any of what we have coming up?
Well, I look forward to seeing people in Montreal. We're focusing on the founder fuel impact on the Montreal ecosystem. So I think it'll be lots of fun.
It will be lots of fun. And Alex, thank you. Enjoy the warmth over there in Florida. And I appreciate you taking the time to break it down for us. As always, if you enjoyed today's episode, please like and subscribe wherever you're watching or listening. And we will be back in 2 weeks' time with more TechTO Quick Takes. And until then, we will see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.